This is part 3 of tonight's program on launching an Opportunity Zone Fund within our Opportunity Zones Meetup. We're going to talk about management, and from there we're going to jump into what exactly is a fund required to do. At its very bare minimum, the fund is a statutorily mandated entity who's going to take cash from qualified investors. Qualified investors are those who are holding recognized capital gains from both the sale of either short-term or long-term capital assets, who want to roll that over into this particular type of investment in order to gain the tax incentives that are available for this type of investment. So if you look at it in its bare minimum, you have to set the fund up correctly. And then every 6 months, you're going to have to file with the IRS the reports that say, these are my investors, this is what we did with the money that we raised, and if we do this in this particular example, we would raise $8.5 million. We would deploy $8.5 million, so we're at 100% deployment of our funds. We will have a list of all of our investors. How many that may be is open to it, depending upon who comes into the situation. And from there, the IRS will be able to cross-check individual tax filings or business tax filings, go, oh yes, you're listed over here as an investor, and when you check the box that you're qualified for a capital gain tax deferral, these are the same tax ID numbers, these all match up, nothing has occurred. Then everything can sit essentially with very modest filings for 10 years, because this is not making multiple investments, it's not doing multiple assets, it's a single purpose, one-time thing. We get to the end of the story and the cash exits occur, and at that point in time, we would anticipate that in this project we would buy out the investors, that is the Sugar Beet, that NetZero Colorado would buy out the fund. It says, we're going to buy all our stock back, we're going to give you cash, and you as the fund are going to distribute that cash to your investors, and you're going to file a report with the IRS that said, we cashed out, everybody's out of the game, this is a done deal. So it would be a very, hold, set, report 20 times, and do a final report saying all the money's distributed, we're done, we're out, we're shutting down. Now, there's a bunch of ways to make this more complicated because we might have an investor into the fund. We don't currently have a mechanism built into this investment structure that would allow them to do it with our participation or cooperation. But by law, they're holding stock essentially as a minority shareholder in a corporation, and as long as they've held it for at least a year, then they have the opportunity to go sell to any other private person that they want to. And so they can go out on their own, and they will have to ask our permission. They have to make sure that everything's in legal compliance, but if those two steps are met, we really don't care. They can resell their stock anywhere during this 10-year cycle, take themselves off of our report because they're no longer an investor in our fund, but whoever they sold to is going to step into their shoes, but they may not get the same benefit because they're not in the same time frame. Now, if it turns out that that person invested into our fund by acquiring the stock, it's not clear to me right now that they're going to get any of the tax benefits, or if they sit there for the 10 years or whatever year period is, are they going to get the kind of benefit? Obviously, if they buy in year 3, they'll never be there for the 10. If we cash out at the end of 10, if we leave this for the maximum going out to 2046, they might make a 10-year, but I'm not clear on that from reading the rules on how that's going to work. But it is going to impact the reporting here, which is why I raised the question that from a duty standpoint, the principal duty of this entity is to exist, to validate to the IRS who invested, and to provide them with that information so they can verify that they do qualify for these tax incentives based upon how long they stay in. If everything sticks and nothing changes for 10 years, then basically they open the door, money's distributed, you make your final report and go home. Shouldn't be a big deal from a reporting standpoint to do this. Again, if you're in a corporate structure, it'll be simpler than if you're in a pass-through structure where you have to do K-1s and all those kinds of things. That's why if you use a pass-through entity and you're recognizing the income at the individual level, you're going to be filing 1065s and you're going to have to do all that reporting over and above, where here if it's a taxable entity, it's a single point. Second question then is the fund going to have to raise money into itself in order to operate? So in many cases, most cases, the fund's going to have to go out and get money from another source. It's going to have to find investors, it's going to have to recruit them, it's going to have to engage in a capital campaign and bring that money into the fund in order to get this whole project rolling.
Well, you're talking not tax benefited funds, not profitable, not capital gain funds? What kind of funds are you talking about? Raising
It would be any Opportunity Zone fund.
Right, you're talking about at the fund level? Or
At the fund level. So in some cases, though, I'm talking with people who have their own cash.
Right.
They're going to put it into a fund they create for themselves. They're not actually raising money,
right,
even though an investment's made. There's no solicitation, there's no securities offering, there's none of that regulatory requirements there.
Okay.
So initially, if I'm doing an ordinary fund and the guy's funding it himself, I have IRS regulations to conform to, and that's it.
Right.
But if I have to go raise money from somebody who's not part of this, not on the management team and all that, I have securities laws that I have to conform with also. And it creates a new set of requirements across the board. Yes?
But in a situation where a person's putting their own money into the fund, they can actually leverage, the fund can get leverage to do the improvements or whatever. Is that correct?
Yeah, so the question is that any money that's invested into a fund, can it be leveraged? That is, can you go to a bank or any other person and borrow money? And yes, you can. There's no restriction that I've seen anywhere in any amount. So if somebody were willing to loan you a 99-to-1 debt to equity ratio, you could go do that. That's fine, and that gives you more capabilities of doing things both in management of cash, doing other things back and forth in your structure, who you're playing with in creating your capital stack. And yes, we are looking in the Sugar Beet district, particularly in the second stage where we're getting ready to do the horizontal development, we might have 10 new sources of capital that we're putting together to weave that together from certain types of debt, certain types of environmental improvement type funds, TIFs or property tax, all these different things. We're going to look at everything, and if we happen to qualify for 4 or 5 grants, that gives us a little more action in there. We're going to go after those as well. So in that case, yes, leverage it, grant it, everything that you can do. As far as they're concerned, though, the IRS, is that it's the equity investment that is going to qualify for the capital gain. If you can stretch that by leveraging it, good for you, by getting a higher ROI on each dollar that's actually invested. So next question that comes up is, what are the responsibilities of the fund as an entity that's set up specifically for this purpose to engage in due diligence? So as an example, as I answered Ross's question earlier, the Sugar Beet District Fund is planning a 506C style offering. This is a public offering, not a registered offering, but public, meaning we can advertise it anywhere. We can go anywhere in the world to get investors to come into the fund. But we have to certify that everyone who makes an investment of this nature is an accredited investor. And there are rules set out by the SEC on how you go about verifying that someone did meet the accredited investor standpoint and you didn't by chance sweep up a non-accredited investor along the way. Now, we won't get into detail on that, but the fund, because it's sitting there, even if it's managed by somebody else and even if the money's passing through it to the asset company, is going to have an obligation to verify that in this case, each of the investors are accredited investors. If you're using a 506B offering where you're allowed to sell up to 35 non-accredited investors, you also want to be sure that you're not publicizing the campaign, because that is a classical, old school private offering, and you can't put that information out there where everybody can see it. And I suspect, and some of the challenges that we saw with the site that the state set up for matchmaking investors with projects, are that an old style classical private offering should not be listed on that site if we were to take a very conservative interpretation. Their position is they're just making a statement, which historically you could have gotten in trouble with certain agencies, but everybody's gotten looser on that over the decades, so maybe it won't be an issue. The other thing is you're going to pass money through to a qualified opportunity zone property or business. You need to know that the money was spent correctly so that you are not disqualified from the tax incentives. How do you go about proving that, knowing that, so that if there is a claim made later on that the money was not deployed on time or is deployed outside the zone or any of those other things, how you know that's going to occur? So somewhere in here, even in a pass-through entity, this entity is still going to be responsible for telling the IRS that the information on our report is true and accurate. They can't just take information and stamp it and go, that's what we were told. I think that's going to get whoever is in charge of this, officers, directors, in trouble. So you're going to want to make sure that there are procedures and methods in place to validate this information to a reasonable degree of certainty, so that there's no potential that the IRS claims that fraud was committed by reporting false information. And that has to occur for the entirety of the 10 years. Now, if it's a real estate, you've made your enhancement, you've met your requirements, you're past the bar early on, that's no big deal. If you're engaged in an opportunity zone business where you have to have certain of your income occurring within the zone according to the new 4 rule test that came out last week, you're going to have to go back every 6 months and say, you know, do you have record keeping within this organization to verify that you did conform to the rule? And some of them are fairly simple for certain businesses, but there are going to be certain businesses of size and complexity who are in multiple sites, and this is going to get harder. Now, the other thing I'm a bit troubled by is there was lots of discussion about modifying the rules to require additional reporting requirements. And this is getting into the fact that some people are unhappy that somebody might get wealthy by investing in a distressed community, and certain types of investments are currently politically incorrect or unfavored. And so we may see another set of rules come forward in the future that amplifies this reporting requirement, which will amplify the ongoing due diligence. And if you are managing a fund for somebody, I would allow a little tolerance in there in your fee structure, however you're setting that up, to make sure that you can go out and again validate that this information is correct before you submit it to the IRS.
So you're saying the IRS may be requiring more information of the investors in the fund?
It's under discussion, and you're seeing things like the anti-gentrification discussion going on, where they're saying, well, this money was put into the community, but it didn't help the community, it hurt the community. And yeah, we're into very subjective and different opinions there, but it wouldn't surprise me to see someone try, they may not be successful, but try to impose more reporting requirements on where did the money go, what kind of outcome was created by the thing. Did it create a job? Did it do some other positive impact in the community, which is common to an impact investment or social investment. And I'm basically against it, because that reporting could put a number of these small businesses, small projects in a position where the cost is getting prohibitive for them to go down this path. They certainly shouldn't do it after the fact. So we'll see. Liability, again, what happens if something goes wrong? Because the fund has engaged in the sale of securities, except in those few exceptions where the investors are the owners, controllers of the fund, then there is a potential liability that securities violations occurred, whether they're nominal, bureaucratic, form-filling types of things, or all the way up to including securities fraud. If there is a liability, the fund needs to be carrying some form of insurance or some kind of a guarantee indemnity from the asset company or from a management company to say, if this goes wrong, we'll take care of this. You can't leave this as an empty shell out there blowing in the wind, and if something goes wrong, go, we don't have any assets to address this particular issue. So the one would be a failure to report correctly to the IRS. The other would be a problem associated with raising the capital. And in both cases, you're going to want to make sure that there is protection in place, particularly for the individuals who are conducting these activities, if they perform them in a business-like manner and for whatever reason it creates a liability for someone. Conflicts of interest. This is one I expect to see all kinds of new and interesting stories in the not too distant future, particularly where you have a dedicated single-purpose fund that was created to raise money for another company. And as we are doing, and I'm seeing everybody else doing, there is an overlapping board of directors between the fund and the opportunity property or the opportunity business, which automatically creates a conflict of interest. Now, some people get very, very excited when you hear conflict of interest, and they assume that somebody should go to jail immediately, but that isn't the way it works. Conflicts of interest occur naturally all the time, as long as they're basically disclosed and everybody gets to make decisions whether they're going to participate or not based upon the existing conflict, everything's fine. But there could be situations arise where the conflict of interest may roil over into decision making that can't be readily taken care of. So say, for example, here we set up the fund, we have 3 boards of directors to meet the minimum requirements, and the same 3 people are the same board of directors for the asset company. 6 years in, there's a disagreement between the people on whether this project should go forward or take a left turn or do something that needs an extraordinary decision. A conflict, which has been there throughout, is now going to boil up and over and become something that's a potential mess because who's voting what? In the case we set up, we have a single share of stock, so we're not splitting shares here. But if we have 2 of the board members say we want to go one direction and one says another, majority will control, but a conflict's been created that may be more problematic. So again, thinking through this going forward, think of all the entities, think where you have somebody sitting in 2 positions wearing multiple hats. If there is a multiple hat scenario taking place, think about how you would resolve a dispute, a conflict, a disagreement, a change of strategy, any of those things. In some cases, you'll see this where companies form where partners are equal, but if a dispute arises, they have a third party already set up in advance to break the tie. These are things that need to be looked at where we're seeing single-purpose dedicated funds and everybody's wearing multiple hats.
So there's an opportunity here for an opportunity zone arbitration business?
Yes, there could be. There are actually a lot of good companies out there that mediate real estate issues, and they're specialists in this area, but it might be good to know who they are and have them lined up or even write them into the agreements. That first preference would be that this group is hired to handle disputes of this nature, or to if there's a question of whether or not this is going out of bounds, they may give feedback of some kind to help guide the decision-making process, and that's embedded into the actual minutes of the organization. Compensation. We've got this company now that is going to be filing reports. it's going to have to do some level of due diligence and filing the reports with IRS. At the same time, they may also be raising money and having to do compliance with the SEC. So work is being done. How are these people being compensated? One of the ways that could occur is for part of the money raised from the investors is used to pay for fees of this nature. And we'll talk again about this more in the next section, dealing with the 90-10 rule. But this may be something that is charged through to this. And the question is, what are you paying for? Is it hourly? Is it structured? Is it locked? Based upon what's going on, as I said before, if there should be additional rules on reporting imposed later down the road, are you locked into a compensation structure that's only going to become unprofitable and cause a problem for everybody? Similarly, if the people are raising money into the fund, they can do that as an exemption to the broker-dealer requirement because they're an officer or board director in the fund. They can raise this money. They're not allowed to take a commission. That's an out-of-bounds situation. So we want to also make sure that whatever compensation is provided is legal and it's in conformance with SEC rules with regard to sale of securities. So for this section, one of the things I'm going to provide to you is the management contract with the fund. So in this case, NZ Development will have a contract to provide all the services, perform all the duties, all the due diligence I just described for the benefit of the fund, and it'll be an outside service that's doing this. And there's other companies that are coming into the market. You're indicating, John, there's a whole raft of different services that may be outsourced here because they're just complicated enough or bureaucratic enough or volumetric enough that it's going to be easier to outsource this rather than do it in-house for any number of reasons. And we're going to anticipate a lot more companies come into it for that purpose. Now, these may be services that are extension of the legal services or accounting services that some of you may hire. Some may not want anything to do with it. As I was exiting the program last week, I was talking with an accountant who didn't really get really excited about opportunity zones, figuring it was still a problem yet to be figured out. But this will be one of the documents that you'll get a copy of upon distribution. Any questions at this point? Okay, this will end this part of the program.